The world believes the 2008 financial crisis is over. Markets recovered, banks survived, charts went back up. But that belief is comforting and dangerously wrong. The 2008 financial crisis didn't end. It just changed form. What collapsed in 2008 wasn't just banks or housing prices. It was an illusion. The illusion that modern financial systems are stable. The illusion that risk can be engineered away. The illusion that debt can grow forever without consequence. And instead of dismantling that illusion, the world chose to preserve it. To understand why the crisis never truly ended, you have to stop seeing 2008 as a sudden accident. It wasn't a freak event. It was the inevitable result of how money had been redesigned decades earlier. In the early 2000s, the system looked calm. Interest rates were low, credit was cheap, governments wanted growth, and growth needed borrowing. So borrowing was encouraged. Home ownership was pushed as policy. Banks were rewarded for lending more, not lending better. Mortgages were no longer just loans. They became raw material. Loans were bundled, sliced, repackaged, and sold as investments. Risk was no longer something to avoid. It was something to move. Banks didn't care if borrowers could repay. They weren't holding the loans. Rating agencies didn't care if assets were safe. They were paid to approve them. Investors didn't care what was inside. They trusted the label. Everyone believed the same thing, that spreading risk makes it disappear. But risk doesn't disappear. It concentrates. And when it breaks everywhere at once. When housing prices stopped rising, the system didn't wobble. It froze. Because modern finance doesn't run on money alone. It runs on trust. And trust vanished overnight. Banks stopped lending. Markets stopped functioning. Institutions that looked solid were suddenly hollow. Lehman Brothers didn't fail because it was unlucky. It failed because the system had no margin for error. That was the moment everything could have changed. The moment where failure could have restored discipline, where leverage could have been punished, where risk could have been forced back onto those who created it. But instead, a different decision was made. Governments stepped in. Central banks intervened. Trillions were injected. Interest rates were slashed to zero. The crash stopped. But the system wasn't rebuilt. It was stabilized. And there is a critical difference between fixing a system and supporting it indefinitely. After 2008, the world didn't reduce its dependence on debt. It increased it. Markets didn't become less fragile. They became more dependent on intervention. Banks learned a powerful lesson, not about caution, but about rescue. If things get bad enough, someone will step in. And that belief changed behavior forever. This is where the crisis transformed. Instead of dramatic collapses, we got permanent distortion. Instead of crashes, we got inflation. Instead of visible panic, we got silent pressure. Housing didn't become safer, it became more expensive. Stocks didn't become more productive, they became more liquid-driven. Debt stopped being a warning sign, it became the foundation. Today, the system looks stable because it is constantly supported. Central banks backstop markets. Governments normalize deficits. Asset prices float higher, disconnected from income and productivity. This isn't recovery. It's suspension. And the cost doesn't arrive as a single event anymore. It arrives slowly. Wages struggle to keep up. Savings lose value quietly. Ownership moves further out of reach. Inequality hardens into structure. Nothing collapses, but nothing resets either. This is the modern version of the same crisis. In 2008, the damage was fast and visible. Today, it's slow and normalized. Back then, millions lost homes. Today, millions can't afford one at all. Back then, trust collapsed suddenly. Today, trust erodes quietly. And because it's gradual, it feels inevitable, almost natural. But it isn't. It's the result of a system that never accepted limits. Limits on leverage, limits on growth, limits on intervention. Those limits were postponed, not restored. The most dangerous outcome of 2008 wasn't the crash. It was the belief that the lesson had been learned, that regulation alone fixed it, that safeguards were enough, that history had closed the chapter. In reality, the system became more complex, more leveraged, and more dependent on constant support. Which means the next correction won't look like the last one. It won't announce itself with collapsing banks and dramatic headlines. It will arrive through stagnation, pressure, and lost opportunity. Harder to explain, harder to escape. The 2008 financial crisis didn't end because the conditions that caused it were never removed. They were stabilized, renamed, and extended. What changed wasn't the system. What changed was how the damage is delivered. And systems that require permanent support are not stable. They are waiting.